So the UK economy's clearly been struggling over the last year as we've seen the fallout from the previous budget. And currently, investors are very concerned about, potential tax rises coming from the budget in November. And that uncertainty is, causing a lack of confidence, a lack of investment and a lack of consumer spending. In our view, the government now needs to try and rule a line under that uncertainty. And in doing so, I think they'll have to, put up taxes, raise somewhere between 20 or 30 billion and probably, break one of their pledges around income tax, national insurance and VAT. And so that's been a big focus, but I think if you can remove that uncertainty from the market and say, well, we've actually done something that, most economists would say is sensible, that fiscal tightening, is it 20, is it 30 billion? It will be, 0.3, 0.4% of GDP, so not great. But I think actually the opportunity for the sort of pent-up demand from corporates, from consumers, remains significant in the UK. And it's that the government, in their 18 months in power has really, I think, missed a trick in terms of the consumer. So we remain quite enthused by the consumer. We remain quite enthused by consumer stocks as the savings rate's very high, and we think consumers can spend more if there's a bit more confidence. So the fund, we are bottom-up stock pickers. We spend all our time, looking at companies, looking at their peers, looking at their customers, looking at their suppliers, trying to get an insight into a sector and a company at a stock-specific level. But we've always been of the view that you can't look at stocks in isolation. They live in the world, and the world, changes through time. So as we think about the UK economy today, we do think growth will be a bit slow. We do think inflation will come down, and we do think, interest rates will move materially lower over the next 12 to 24 months. And so that's an opportunity for sort of interest rate sensitive stocks, things like house builders, things like REITs, which have been quite weak, trading at very big discounts to NAV. And so, we combine that bottom-up insight into those individual stocks with that top-down view that actually the interest rate cycle is probably going to turn faster and go further than people think. So the fund has done well out of financials. That will be both banks and insurance, and indeed some of the asset managers, things like 3i, things like Intermediate Capital Group. But the banks is the one we find all our investors are so keen to talk about. Because they have been so bad for so long, and then over the last 2 or 3 years they've been exceptional performers. We're very much focused on free cash flow and believe that as long-term holders of UK equities, our returns are going to correlate very strongly with the free cash flow of the companies we own. And if we look at the domestic banks today as an example, they're on distribution yields in the low to mid-teens as you get out to 26, 27. And in a world maybe where interest rates are 3%, we just think those distribution yields are far too high. And the opportunity, therefore, is that actually those shares continue to re-rate on a growing earnings base with growing dividends. And there isn't a lot of growth in the UK economy, so there's not a lot of growth in banks' balance sheets. And that means they've got the surplus capital they're generating, rather than making new loans, the best use of it is to give it back to shareholders. And so we still see them as being attractive. As I said, we're sort of free cash flow focused, so we get pigeonholed as value investors, but we do fundamentally believe the price you pay for an asset has a big determinant in your long-term returns. And I think when you stand back and look at equity markets, the big surprise this year is just how much they've all re-rated, despite all the uncertainty of tariffs, of the change in interest rates, the geopolitical uncertainty in the Middle East, Russia, Ukraine. All these things are still going on in the world. But I think fundamentally investors have become just more cautious about government's ability to have some fiscal discipline, about central banks' ability to control inflation. And so you've seen a desire for real assets. And the UK has a lot of asset intensive, balance sheet intensive, real asset type businesses. And we think those are well placed to prosper in a world of not zero interest rates and not zero inflation, which is where we are and we think where we remain.